Good to see you all. It's always most difficult going at the end of a bunch of sessions, so I'm going to try not to put you to sleep. But I have only 15 minutes to do it. I've been teaching and talking about corporate finance and valuation. So a bit of warning, I'm a micro person. There's going to be no macro stuff from me, no big stuff, so you're going to be a little bit disappointed if you're expecting answers to the problems of the world. And I've been teaching corporate finance and valuation for 4 decades. And I've become more and more cynical over those 4 decades about what I call the weapons of mass distraction. What I'm talking about are words that people use in business to justify decisions that are unjustifiable, to do things that they've always wanted to do, even if the numbers don't go along. Now, I'll give you an example. Synergy in a merger. Everybody talks about it, but in only 1 in 6 mergers does synergy actually show up. Here's my most dangerous word in business, at least until a few months ago: strategic. You hear the word strategic, you know that bad decisions are coming down the pike. A strategic deal is just a stupid deal. You shouldn't be doing it, but you really want to do it, and you justify it as strategic. If you're going to sell your business, find a strategic buyer. Just another word for somebody who will pay you whatever price you ask. But what I want to talk about today are 3 words, acronyms, phrases that have become dominant over the last decade that I think undercut their endgame. I'm going to spend the bulk of my time talking about ESG. I know it's now part of a political debate, but my point with ESG is it's undercutting its own endgame by the way it's been sold and the way it's been presented. The second word I want to talk about, a set of words, is stakeholder wealth. A concept that only a lawyer can love, which is part of the reason I think it was born in law schools and pushed to the forefront, which is the notion that businesses should be run in a way that maximizes stakeholder wealth. I'm not even sure what that means, and we're going to dig a little deeper. And the third is a word that many of you probably use as a word in business that I find almost ununderstandable in terms of what it covers. That's the word sustainability. So I'm going to hit some prized words in these next 10 or 12 minutes, but I'm going to open it up for you to think about where these words are going to lead us. Let's start with this notion of sustainability, buzzwords. Through the history of business, we've used buzzwords to justify taking actions. And when you look at ESG, I think the first 2 questions I think we need to ask is, what exactly are these services that claim to measure ESG measuring? I've asked this of Sustainalytics, I've asked this of S&P, and I am confused. And I'm going to throw that confusion out to you, and maybe you have a better explanation of what exactly an ESG score measures. The second is something that's close to me, which is valuation. I talk about valuation. And I've heard people pushing ESG arguing that if you are a good company, if you score well on ESG, you're going to be a more valuable company. And I'm going to push back and ask, where? Where does it show up? The third point I want to make about ESG, and this is especially true if you're an investor, is that if you invest in good companies, you will earn higher returns. And finally, of course, there's a societal payoff, that if companies become better companies, score higher in ESG, that somehow we as a society will gain from that advance. Let's take that first question. What exactly does ESG measure? I used to think that ESG was a measure of goodness. That's what I was sold. I was sold that by investment funds telling me if you invest in companies that score higher in ESG, you're investing in good companies. And already we're on dangerous ground, because goodness is person-specific. Your measure of goodness, my measure of goodness, and somebody else's measure of goodness are not going to converge. So the puzzling question is, how the heck does Sustainalytics come up with a list of things that comprise goodness and arrive at a score that we all agree on? So let's start with that measure, what exactly ESG measures. And I'm going to start with a couple of statistics that should trouble you about ESG. Do you know that bigger companies score higher in ESG than smaller companies? And I don't believe that bigger companies are somehow better on goodness, but they score higher in ESG. File that away. You know that as disclosures increase at companies, ESG scores go up. In other words, you add another 50 pages to your 10K, on your carbon footprint, your ESG score goes up. What this suggests to me is that ESG is a lot more gaming than a measure of goodness. I think it was revealing when Tesla was removed from the S&P ESG index, the defense that was offered by S&P's team that removed Tesla. Now, we can debate whether Tesla belongs in a list of good companies. But when you remove a company like Tesla from the ESG index, you've got to have a good explanation of why it went away and ExxonMobil stayed. And I remember the head of S&P's ESG team said, it wasn't that Tesla's score dropped, it was scores of everybody else went up. How that happens, I don't know, but that suggests to me that there's a game going on. If you play the game well, you can improve your scores. If you can improve your scores, you're going to get a higher ESG score. So when I wrote about this about a year ago, the pushback I got, and this surprised me, and this was from the head of Morningstar's ESG group, he said, ESG is not a measure of goodness, it's a measure of risk. I say, okay, but what kind of risk? Is it a measure of default risk, in which case you already have a bond rating that S&P and Moody's supposedly puts out? Is it a measure of equity risk? In other words, are companies that measure higher in ESG more risky or less risky than companies that score lower? And if you look at the evidence, there is actually very little evidence suggesting ESG is a measure of risk either. So at this stage, I'm completely confused. When I see a company with a high ESG scores, I don't know what to read into that score. It's not a measure of goodness. It's not a measure of risk. All it is a measure of how well you play the game. Keep that in mind when you start to look at the evidence on whether ESG is good for companies. When I teach my valuation class, I start the class with what I call the IT proposition. And here's what the IT proposition says. If it does not affect the cash flows and it does not affect risk, let's stop talking about it. And you can put whatever it you want, brand name, you can put in competitive advantages, you can put in patents, and you can work through the effects of it through the cash flows and the risk. So when I heard this pitch that ESG is going to make you a more valuable company, the question I asked was, where does it show up? The companies that score higher in ESG, do they grow faster? And if you look at the evidence actually suggests the opposite. That ESG actually prevents you from scaling up because to be a good company, you've got to be almost a niche business. A Patagonia can afford to be really good because it has less than $1 billion in revenues. But if you're Nike and you have $35 billion in revenues, you're going to find it much more difficult to remove portions of the market from your reach because you've got too many people who need your product. I said, is it that they have higher margins? And there is some evidence that companies that score higher in ESG have higher margins. But the statistics of it is incredibly difficult to test. And here's why. What if I told you that I've done a research study that suggests that if you shop at Whole Foods, you will get richer? You know, statistically, if you run a regression of how much you make against how much you shop at Whole Foods, you'll see a very strong positive correlation. And of course, you can see the problem with that study is it's not that you get richer because you shop at Whole Foods, it's because you're richer that you're able to shop at Whole Foods. The same problem is a blight on ESG research. When you tell me that companies that score higher in ESG are more profitable, I'm going to reframe the question and ask you, is it that more profitable companies are able to game the system better to get a higher ESG scores, and how can you reject that hypothesis? So when you look at the evidence on whether ESG is good for value, there is very little evidence in terms of revenue growth or margins or reinvestment in the cash flows that being a good company is going to create value. So the question then is, does it make you a less risky company? And here there is some evidence backing up ESG. But it is on the dimension of not being a bad company. Bad companies can end up with more risk. And if there's any evidence that you can use to back up the proposition here, it's don't be bad. If you ask me, should I spend extra money to be a good company, there's nothing backing up that proposition that spending the extra 50, 100, 150 million to be a company that measures higher in the goodness scale is going to get you a payoff. So we don't know what ESG measures. We don't know whether it's good for value. Let's turn to the third pitch. that if you're an investor, investing in good companies would deliver higher returns. The problem with that is it depends on the price you pay. If markets are already pricing in goodness, and you pay that higher price, you will earn lower returns rather than higher returns. Investing is messy. You know that badly managed companies often deliver higher returns than well-managed companies. That sounds weird until you realize that if everybody thinks a company is well-managed, they're going to push up the price. The price you pay will then reflect the management, and all you can then have is a negative surprise. Whereas if you invest in a company where investors think the managers can't chew gum and walk at the same time, the fact that they can do both is a positive surprise. It's not fair, but on an investment front, there's again very little evidence that ESG makes sense. So the question is, should we still go along with it because it's good for society? And that really is what it boils down to. Is it still okay, even if it's good, not good for companies, it's not good for investors, should we push this along because it's good for society? And here's where I think we do the most damage. I think what we've done with ESG is we've given people a free pass. Ultimately, you want to make the world a better place. It's got to start with your actions. Your actions as a consumer, your actions as an investor, your actions in society as a voter. We've, in a sense, outsourced goodness to the CEOs of companies. I don't want Jamie Dimon deciding what's good for me. I want to preserve that freedom to make the judgment on what goodness means and where to invest and what I should be factoring into my investment decisions. This is not about bringing virtue into investing. It's about doing it at a personal level rather than outsourcing it to an investment fund, or to a service, or to a CEO. Let me close with a couple of final thoughts on ESG. If you look at where we are now with ESG, you can see that the storm that's been brewed by what ESG created. We now have two fronts, and both I think are wrong. The ESG front and the anti-ESG front. You almost have a red-blue divide on ESG. Nothing that becomes this political can have a good end game for business. Which leads me to two final thoughts on the alternatives, the things that I think were offered as alternatives to ESG. One is this notion of stakeholder wealth maximization. As I said, that was a notion that was born in law schools and has been nurtured in law schools. And let's think about the practicality of bringing it into a business. Let's start with the truth. Every business has multiple stakeholders. You got stockholders, you got bondholders, you got customers, you got employees, you got society, you got suppliers. Obviously, they all matter, right? At first sight, the question is, why do we put shareholders on top? In classical corporate finance, or you go to the Delaware courts, shareholders have primacy. And that seems a little unfair. Why pick them out of all of these stakeholders to put at the top? And there's a good reason for it. Every other stakeholder in a business has a contractual relationship with the business. In other words, you're a lender. You don't trust me as a business. You get to set an interest rate. You get to write covenants. You're an employee. You entered an agreement. We can argue about whether these contractual agreements have become too weak. Maybe we need to strengthen them. But in an agreement to work for a firm and get paid. You're a customer. You decide to buy a product or not to buy a product. And again, we can debate how strong that contractual agreement is. The only group that is contractually unprotected are shareholders. The only right they have is to whatever's left over. If you don't give them primacy, why would you ever invest in the equity of a business? If you tell me you get whatever's left over, and I'll decide what you have left over, after I've met every other group's needs, why would you ever invest in the equity of a business? There's a reason shareholders are given primacy. And a system that says, let's make everybody happy will do two things. It'll make nobody happy. And CEOs love it, because if you're accountable to everyone, you're accountable to no one. That's part of the reason you get groups like the Conference Board, 171 CEOs from the largest companies in the US, buying into a stakeholder wealth maximization maxim, because if you're accountable to everyone, you're accountable to no one. let me leave you with my final thoughts. I could spend an hour on sustainability. I'm not going to go there. But a few weeks ago, I was asked to talk to 50 chief sustainability officers, some of the largest companies. And I walked in completely blind to what they did. So I said, tell me what you do. I have no idea what you do as a chief sustainability officer. And after about 45 minutes of them telling me what they did, I was still unsure. As I saw it, there were 3 ways you can think about sustainability. One is that they make you think long term, that that's their role. Now, you must be some kind of Dalai Lama to be able to do this in a company, that to be able to see what's going to come in 20 or 50 years. So maybe if you're one of those people who can make 300-year plans, that didn't end very well for Master Son, and you can see that far ahead, maybe that's your role. The second was that I was watching the Pinocchio movie, and you remember Jiminy Cricket, right? And the second role that some CSOs said is I act as the conscience. I remind the company. And I said, okay, that makes sense. So Pinocchio ignored Jiminy Cricket most of the time. At least you have somebody telling you what's right or wrong. And there's a third group that terrified me. They said, our job as CSOs is to make sure the company survives and lives forever. That's not going to end well. You're going to end up with walking dead companies. It ties back to something I said in my last session with Pivot, which is about corporate life cycles. There are times when a company as a legal entity has there's no reason for it to continue to exist. To have a CSO whose job it is to make sure it lasts forever is, I think, undercutting the need for that company. So when I think about the theocratic trifecta, the reason I use that is because some of the advocates, not everybody, believe that they have the moral high ground. And because they have the moral high ground, they don't feel there's a need for debate. And I think that's weakened every one of these concepts. ESG would have been far better off if there had been a pushback earlier on, where you didn't tell everybody that they could have it all and not have to sacrifice. The history of humanity is goodness has always been the more difficult path. It's required sacrifice. If you're a company and you want to be good, you will have to give up something. If you're an investor and you want to be good, you have to give up returns. That's the way it should be. And if you tell me that I can have it all, you're either doing it because you want me to sell me on the concept and there's no good reason for doing it, or you're doing it because you truly believe in it, which is truly scary. I've run out of time, and thank you.